Hello, I'm about to give a chalk talk on managing for shareholder value, getting management aligned with investors. Let me share my screen and we can get started. Okay, so let me start with what a safe harbor statement. You know, a lot of earnings calls start with a safe harbor statement, but you're not supposed to take anything in this call for giving a signal for buying anything. I have a different kind of safe harbor statement when it comes to managing for shareholder value. Because, you know, investors are not the only stakeholders that enterprises should pay attention to. But in the 1990s, that's kind of how we played the game. The board of directors had this fiduciary responsibility to shareholders, and frankly, all other stakeholders were ignored. They weren't even mentioned in the agreement. That led to some very negative consequences, unintended but very negative, including I think the tech bubble in 2001, where we just overbid the stock again in the interest of shareholders, but nobody else. And then in the 2008 financial crisis, again, when you wildly overemphasize compensation with respect to increasing shareholder value, you create foolish behavior and eventually risky and potentially illegal behavior. So what we're doing today, we're saying, look, there's a complete stack of constituencies that companies and management should pay attention to. And everybody has a slightly different priority order, but this is mine. So I would say to a management team, your number one priority, your number one stakeholder are your customers. They are your reason to be. That's why your company exists. You are in service to them. And so they come first. And then I would put my employees second because they are the ones who are going to deliver this value to the customers. So without this alignment of the customer and the employee, nothing good is going to happen in the world. So I think those are the number one and number two priorities of management. That said, I think shareholders do come in number three. You do need to attract capital necessary to invest ahead of your returns, and you need to reward that capital in order to have it come back. So it's a very important constituency for sure. I think partners are coming just behind that. Partners are key to creating what we call the whole product. It's the ecosystem of companies that come together to make it all work together. If you don't have good partner relationships, your customers tend to get patchy and uneven results from their investments with you. So I think it's very important. The local community in which you work is becoming increasingly important. In this year of the pandemic, very much so, but in any year, your local community is part of your family, and it's part of the business's responsibility to be a platform for change in your local community. And then in the global community as well, society in terms of things like diversity, equity, and inclusion, you know, the private sector has to lead here, has to step in, and the society as a whole is a stakeholder in your enterprise, as is the planet. And so the ultimate stakeholder, I suppose, for all of us is the environment and the whole notion of having a sustainable planet. Having said that, what we are going to do, this presentation is going to focus specifically on shareholders and managing for shareholder value because it's a worthwhile effort. It just isn't the only effort. So with that in mind, the agenda is as follows. I want to give you a framework for understanding how market caps are created, where the valuation comes from. And we're going to see that it relates to competitive advantage. So we're going to deconstruct competitive advantage as it relates to market cap. And then we're going to talk a little bit about the behavior of markets as they respond to current events. And then in particular, how they respond to next generation, what we call tornado categories, these categories that go into hypergrowth. And we're going to end with a couple of key takeaways and actionable items for the management team. So that's where this thing is headed. So understanding market cap is first. So managing for shareholder value, mastery or mystery? There's a lot of myths around this topic. You know, shareholders only care about short-term result. Wall Street doesn't care about anything else. Or the markets are irrational in the way they're evaluating these hot tech stocks, you know, because they're losing money and they have these incredible market caps. Or management has to make the number no matter what. None of those actually are true. They all have an element of truth in them, but none of them are true. And so the goal of this presentation is to present a framework for understanding what's really going on and to align that framework with factors that management can control so that we can create an actionable agenda for increasing your enterprise's market cap. So that's where this thing's headed. So what does market cap represent? Well, let's start with what's a share of stock? Suppose you buy a share of stock in a company. What does that entitle you to? Well, it entitles you to a share of all the future earnings of that company forever, right? Until you sell the stock. When you sell the stock, then the next buyer gets the share of the future earnings after that. Well, if you take all of the shares of stock, the market cap is the value of all the shares of stock, which means what is the value of all of the future earnings of this company today? And that creates a really interesting challenge for people because you have to create the net present value of all future earnings. And then you have to discount that future for a number of risk factors. So I want to kind of put all this together. There's a book called The Gorilla Game that I wrote with a guy named Paul Johnson, another guy named Tom Kippola, that goes into this in quite detail for investors. But we're on a management basis. Let's just look at it from that point of view for now. So what does this say? Well, when you're talking to an investor, you say, look, here's how I did last quarter. And the investor says, oh, okay, that shows that you're creating some value. But remember, I get a share of your future returns, not your past returns. You just reported your past returns. So tell me about your future returns. And when you ask management, when investors ask management about their future returns, management's pretty consistent in how they answer. They always say, you know what, we're going to do better. These curves tend to always go up and to the right? And an investor says, you know, I've seen, and these are like future years of earnings projected. And the investor says, you know, I've seen this curve before and fine, I understand, but I now have to figure out how am I going to value that promise in the present? And there's a couple of things a couple of models that we're going to apply to this. One's called net present value, and the other is called discounting for risk. So net present value simply says, look, if I put my money in a bond, and that's the white area of the curve up at the top, I could have a risk-free return. In a typical year, that might be 3 or 4 or 5%. Some years it might be 8%. Some years it might be a lot less. But the point is, if I can get those returns for essentially with no risk, I'm going to discount the present value of your stock by that. Now, what is interesting is that when stock rates are low, it actually creates a very attractive thing for stock markets because the return you can get from a bond these days is very, very low. In fact, in some countries, there's actually negative interest rates, which has the effect of essentially taking that haircut and making it a few clips around the edges instead of like a buzz, right? So as a result, stock markets go up when interest rates go down because the discount for a risk-free return is very, very, very low. But the more important factor in valuing the net present value of the company is the discount for risk. And that is the impact of a competitive marketplace. So here's what happens. What an investor says is, I see that your promises are going up, but my confidence in your promises are going down over time, not because I think you're incompetent, but because the amount of risk that the improbability of your forecast as we go further and further out into time becomes less and less credible. And eventually we're going to reach a place where a certain year where I don't care what returns you promise me after that year, I'm going to value them at zero because nobody has a crystal ball. And I just don't believe you can make any credible forecast out beyond a certain length of time. So that has an interesting effect. So that discount for decaying current competitive advantages creates a curve that looks like this, meaning this is a curve where at some point in time, the investment understanding has said, we will assign no additional value to any promise made once you get past the right side of that dark blue area. So if you look at that dark blue area, what does it represent? I mean, it's the area under a curve. What is it? Well, it's the investor valuations of all future cash flows, returns from this equity discounted for risk. That's what that curve represents. We just constructed it on that basis. Well, guess what? That's what market cap is. Market capitalization is the investor's valuation of all your future returns, the net present value of all your future returns discounted for risk. And so shareholders have a very, very clear message from management. Make that blue area bigger. And by the way, in PowerPoint, this is not very difficult to do. You can double click and really, it's very easy. That's why consultants do a lot better with this sometimes than management teams. But if we say, okay, I'm a management team and I want to make the blue area bigger, what do I do? And it's going to have to do with, I've got to change my competitive advantage. If I can increase my competitive advantage, I can increase both the duration of my returns and the amount of my returns. And so let's just deconstruct that competitive advantage idea so that we can make it more actionable, because everybody kind of gets, yeah, sure, competitive advantage, higher competitive advantage, win more deals, you last longer. I understand, but let's make that more actionable. So when you look at this competitive advantage opportunity, and you say, well, how does the competitive advantage change the shape of this curve? This curve, the y-axis and the x-axis. So on the y-axis, what you can do is you can launch a new product. You can increase your sales force. You can do a bunch of things in the short term that will juice your returns. You can put on special promotions. You can create new alliances. You can enter new markets, launch products, et cetera, et cetera, et cetera. We call that gap. And the competitive advantage gap is based on your differentiation in the categories that you play in from your closest competitors. And what it will do is if you invest in increasing your differentiation, you will create superior returns in the short term, and that will make the curve taller. The other dimension is the x-axis, which is time. Now, time has to do with competitive advantage period, or we call it cap versus gap. And the competitive advantage period is based on the barriers to entry, or partner defection or customer exit that you can create so that you can keep the customers you have and keep the differentiation you have, you can sustain it. So this is about sustaining gap over a period of time. So the longer you can sustain your your competitive advantage, the more value you would get on the x-axis. It makes the curve longer. So we can make the curve taller, and that's more of a short-term approach, and by structurally we can make the curve wider or longer, and that creates a much longer term result. Well, what creates long-term advantage versus what creates short-term advantage? And there's a model we use in our consulting practice called the hierarchy of powers, and it was developed from an investor lens. Basically, the claim of the model is that investors value companies from the top down in this model, meaning the number one selection factor that they pick in their investment is how is the category of this that this company participates, how's it doing as a category? Do I want to put money into retail? Do I want to put money into tech? Do I want to put it into pharma? Do I want to put it into hospitality, right? How is the category doing? Is it growing or is it shrinking? Then within that category, the next question is going to be, well, how is your company doing relative to the category? So if you're number one or number two in a category, you tend to have a lot more value, a lot more clout, a lot more control over your future. If you're number 7 or 12 or 14, you're kind of a bystander. You don't have very much company power. So company power tends to relate to market share. Market power is a really interesting variable, which is, okay, you're in this category, maybe you're 6th or 7th in the category, but in this market, whether it might be a vertical market, like in the retail market, or in the industrial manufacturing market, or in the financial services market, or in the healthcare market, we're number one. Well, that's market power. That's when you've focused the lens of your company on a particular subset of customers, and you've become quite important to them, even though you might in the larger sum of everything not be important. If you remember back in the day, IBM PCs had an enormous amount of market share. Apple Macintoshes IBM PCs had enormous category share. They had like 90% of the PCs were IBM. But the Apple Macintosh had market power because inside the graphic art community, the marketing community, sales community, education community, they had much higher share and had much more influence. And that was market power. Then offer power is how good are your products compared to your competitors, just mano a mano. If you went to a product review sheet and had somebody just size it up, price on a price performance basis, who's got the best product? And then execution power is the ability of your management team to actually deliver results on a consistent basis and very predictably and essentially compete effectively against your competitive set. So when you look at that stack, and those are all things that the management team can affect. If you look at the things that have short-term impact, you're going down the stack. So the further you get down the stack, The more something you do today will affect something tomorrow. And so this is the realm of gap. So if you like change out your head of sales or your head of engineering, if you launch a new product or divest a product, those are things that will change your outcome in the short term. And that's related to competitive advantage gap, and that should show up in the next quarter or two or three in a spike in your returns for that quarter. Conversely, if you go up the stack, you're going to things that are increasingly have long-term impact. So getting into a new market takes some time, and then focusing your energies and getting market share takes time. Building company power within a category takes a lot more time, and then getting into a new category is quite a long-term capability act. You can do these things with mergers and acquisitions, as we'll see, but these are things that affect your long-term power, and this is where the competitive advantage period becomes important. So market cap is a summary measure of all of your power across all of these capabilities. And so when you're assessing, you're looking at your market cap, and you're thinking about, well, what causes our stock to go up or go down? These are the 5 factors I would have you look at. And I would submit to you that that in terms of your stock price, the priority is from the top down. So let's now apply that to how markets respond to current events and see what's going on. So for example, let's suppose you're in the market and you announce your earnings and you do better than expected. So the market forecast you were going to do X and you did significantly better than that. You did what they call an earnings beat. So what does the market do? Well, the market says, wow, we have the wrong curve here. We need to raise the curve up on that left-hand side to match your new performance, because obviously you did better than we thought we did. And then they say, okay, and we'll run that out for your competitive advantage period, and your stock will go up. And basically what you'll do is you've had a gain in gap in the y-axis, but you didn't get a gain in cap. Nobody said you have more competitive advantage or a longer, more durable or long-lasting competitive advantage. So the x-axis didn't move, but the y-axis did, and you get a nice uptick in market cap, but nothing dramatic, nothing particularly dramatic. And by the way, that's kind of you see this a lot in the stock market, that kind of change. Now, interestingly, what happens when you have an earnings miss? Now, let's suppose you have an earnings miss that's the same size as the earnings beat. I mean, it's a miss, but it's not a horrible miss. What does the market do? Well, look at that. First of all, they immediately lower your y-axis, but look what they did to the x-axis. They pulled it way in. Now, what was that all about? Well, the market's thinking, now hang on. We know you guys, when you do your forecast, you always put a little bit of hedge in there. So if you missed your forecast, there's something going wrong. There's something wrong here. And so maybe you're running out of competitive advantage. Maybe you're losing altitude. And so the market very quickly says, I'm gonna whack you on competitive advantage. I'm gonna pull it in. Not because I'm positive I'm right, because I'm scared I'm right. But as a result, what happens is you get even a small drop in gap can create a big pull in cap in the amount of time that the market thinks you can sustain your current competitive advantage. And therefore you get a very big drop in market cap. I mean, 20%, it's not unusual to lose 20 or 25% in a tech sector of your market cap in a day. It's because of, and it's not because of, it's not, although it was triggered by the change in gap, it's actually due to the change in cap. And that's a really key idea there. Okay, so what about M&A? So if you say, well, M&A, because you say, well, look, let's do, and we're going to talk here about the bulls versus the bears. So look at the top row first. So I'm a company on the left. I have a market cap that looks like that. I'm acquiring the company in the middle, and I'm saying this is going to be the greatest acquisition in the history of business, and we have great synergies, and everything's going to work together, and all their faults I'm going to correct, and all my faults they're going to correct, and life is going to be really good. And we're going to end up with 2 categories, which, by the way, are not the same category. I'm not acquiring within my category in this model. I'm acquiring a separate category. I'm Salesforce acquiring Slack, or for that matter, Salesforce acquiring MuleSoft, or Salesforce acquiring Tableau. Those are 3 companies that were in different categories than CRM application software. And so the bull story is, look, this is going to make a much bigger and better company, and that's why the market cap should go up. What often happens, however, when you announce an M&A is you actually get the effect of the bottom. So same company acquiring same company. Well, why does it go down or stay flat? And in fact, often it does go down under these circumstances, because management has presented this very compelling story on the top row. What the investors are saying to themselves is, look, we have seen acquisition after acquisition after acquisition. They're incredibly hard to integrate. The management tends to get distracted. Some people, key people leave. There's the getting the sales forces aligned properly, getting the product lines rationalized. If there's any overlap, is hard. And all these synergies that we're supposed to get, I don't know if we're going to actually get them. And so actually what the bears are saying is an M&A event actually will in the short term reduce the performance of both companies, which almost certainly it will. I mean, there is a certain amount of work that it just takes to pull these things two things together. Management will do its best not to make that a big dip, but it will be a dip. And so if the more short term you are, the more you're going to say, well, look, in the short term, it's going to get worse rather than better. I'm going to sell the stock, right? And that's kind of the classic sort of transactional investor. The long-term investor would be more attracted to the upper graph, and in fact, a lot of long-term investors let the short-term investors discount the stock, brings the stock price down, and then the long-term investor comes in and says, "I actually believe in the top row, but I'm glad to get it at a lower price because of the beliefs of the people in the bottom row." But I'm just trying to give you a feeling. This is not irrational. These are two very rational points of view, both are very sound. But so when markets do things to your company's stock price, they're not like some Olympic god trying to play with your mind or play with the fate of humankind. There are reasons behind this. Now, I specifically want to talk about what happens to your company when a category that you have a business in, a line of business in, goes into what we call the tornado. And the tornado this is specific to high-tech disruptive innovations, although now these high-tech disruptive innovations are expanding way beyond tech. I mean, Airbnb is a technology-enabled tornado in hospitality, and Uber was a technology-enabled tornado in transportation, and Netflix is a technology-enabled tornado in media and entertainment. So tornadoes are going on, but a tornado is, it happens whenever a market shifts from an old paradigm to a new paradigm, and then the money comes in big time. And there's a delay in that process, what we call the chasm. When people are saying, well, I'm not sure when exactly electric vehicles are going to displace gas vehicles. So it doesn't happen at the beginning, but at some point, the market capitulates to the change and, oh my God, it is cloud computing. Oh my goodness, it is mobile computing. And that's what creates the tornado. So in a tornado, prior to the tornado, when it's in the early market crossing the chasm or in niche markets that we call the bowling alley, the category as a whole is valued at some amount, but it's still not proven. But once it enters the tornado, what happens is people realize, holy smoke, first of all, it's now crushing e-commerce is crushing brick and mortar commerce. So the gap goes way up, and particularly in a pandemic, even further up, because you can't, 20% occupancy is the current thing going on in California right now. And then, but more importantly, now it's because people are buying in, because you can recharge electric vehicles everywhere, because you can get cloud computing everywhere, because 2 billion people have mobile smartphones. The competitive advantage period has gotten dramatically extended because it's now going to happen, as opposed to some things that we forecasted happening, cold fusion or bubble memory or whatever, that didn't happen. So now it's for real. So now the investors wildly change the valuation of the category. And that's kind of what Uber and Lyft are enjoying right now in transportation. Even though they're not profitable yet, the investors say, but look, you're not profitable, but you're crushing your competition. and you're in a category that's going to last for a long time. So the fact that you're not profitable means, to me, you're just investing in getting market share. And once the category settles down, you'll have a huge market. You'll be a leader in that market, and you'll be able to create very, very attractive future returns, even though in the present you're actually creating negative returns. So that's a tornado market. Now, if you say, how does that market cap? That's sort of all the available market cap to any companies that are participating in that category. So let's say, suppose there's 10 companies that can be in this category, but they'll be in a pecking order. There'll be somebody that has number 1 market share, number 2 market share, etc. And if a gorilla is somebody whose market share is roughly close to twice the second company's, it's definitely separated itself from the pack. When that happens, here's how the market assigns the portion of the category value to the gorilla. First of all, they say you've got big you're number 1, so you're winning things in the short term. And by the way, as a gorilla, you're getting a bunch of additional support from partners because everybody wants to get on the number 1's bandwagon. And secondly, as long as this category is going to be around, we think you're going to be around. So in addition to having a very good share of the gap, the competitive advantage gap, you also get full credit for the entire competitive advantage period of the category, because the assumption is you're going to be the last man standing at the end of this category. Now, if you compare, so if you say biggest share in gap, full credit for cap, you have the most sustainable competitive advantage. That's what the world believes. That's why the world says it's Intel or it's Microsoft or it's Cisco or it's Salesforce or whomever it is, right? Very, very, very large market caps. Okay. Now, let's suppose you're number 2. Number 2 gets a little bit of a discount on both sides. First of all, you're not, at least overall, you're not as competitive as number 1, although often the number 2 person will use a market power strategy to be very, very strong in their markets. We talked about that earlier. But the gap may or may not be that close, but the cap is significantly discounted because the feeling is you might not be around at the end of this market. If this market consolidates at the end, you might be American Motors instead of Ford or General Motors or now Fiat Chrysler, right? So that's the concern about being number 2. But it's still a very, very attractive market. Okay, you have a little bit lower gap, a little bit lower cap due to competitive advantage relative to the gorilla. So you have a significantly lower market cap than the gorilla. I mean, the gorilla gets a huge market cap. You have a really good one, okay, but it's not the same. And then if you're sometimes they call them a monkey, if you're just an opportunistic player in the market, then you get whatever little gap you can create. And by the way, you can make quite good money in a tornado market as number 10. It's not going to last very long. The key thing, that's why you wouldn't get an investor valuation that's very high. Yes, you're in there, you're doing stuff that's really cool. The PC clone makers all made a bunch of money. But they didn't stick around. They aren't around anymore because they didn't have sustainable competitive advantage over time. So again, just think about market cap as the area of these curves. The purple one at the top, that's the sum of all the market cap created in that category. The dark blue one is the gorilla's share of it. The green one is this number 2 share of it, and the little yellow guys are the rest. Going forward. But it's rational. In other words, based on this framework of investors thinking about gap and cap relative to market cap. Okay, so let me just close this by saying, okay, so what? I mean, so I'm part of a management team. What would I do with this? How do I make this actionable? So 2 slides. So first of all, just take away conceptually. Long-term investors, and by the way, as a management team, you want your stock to be held by long-term investments. You don't want to have a volatile stock price that's going up and down all the time, particularly because you're compensating your own employees typically, at least the upper management tier of your employees, with restricted stock units or in some cases stock options, but normally public companies are using what they call RSUs or PSUs, which I think are performance stock units. But that sustainability, that sustainability is based on your power, your long-term power, and that comes from really these 3 things at the top of the hierarchy of powers. How many first of all, what categories are you in? For each category, what is the amount of secular growth in the category? What that means is the categories itself, is it money coming into it? Is it kind of flat and just varying with GDP? Or is it declining and money's going out of it? And obviously, investors want you to be in categories that have money coming into it. So whether you get all that money or some of that money, the point is there's more money to go get. If it's in the middle, then what they're saying is, okay, the pie is now, we're now kind of into a zero-sum game. So now I'm going to care about your company power, because how much of that zero-sum game can you get, right? And so company power has a big impact on, can you have economies of scale? Can you also have the ecosystems that support you? And then if you're not number one or number two, investors care a ton about market power. And you need to find a way to make that clear to them. And by the way, clear to your company, clear in your whole compensation system. Look, customers within a certain segment are worth more money to us. And by the way, we can give them more value. That's why they're worth. So we're worth more to them if we focus our energies on a particular vertical market or a particular geographic market or a particular demographic, a particular use case, whatever it is. But the point is, none of these powers show up on a spreadsheet. By the time you get to a spreadsheet, all you're measuring is offer power and execution power. But these are the things that affect valuations. So the top of the hierarchy of powers is the domain of PowerPoint. The bottom is the domain of spreadsheets. And it's very important that you not try to lead from the bottom. You need to lead from the top. The second thing is this notion about, well, why are these big whacks in my stock price when I miss an earnings beat? And the point is, long-term investors inspect your performance in order to verify your power. So they will look very carefully at your offer power. They'll look very carefully at your execution power, and because it's a signal. It's a signal to them of your sustainable of your competitive advantage. Period. Because the long-term investor is much more oriented toward the x-axis, competitive advantage. Period. The short-term investor is much more oriented toward the y-axis, which is your competitive advantage gap. Okay. So the long-term investor looks at gap, but they're looking at gap primarily to potentially revise their understanding of cap, either make it longer or shorter. And so to grow shareholder value management, the job of management, regardless in any situation, is going to be, look, you need to invest in power to create and maintain competitive advantage. That's kind of at the top of the top of the hierarchy of powers. But you have to convert that power into performance in order to create returns, because as a public company, you're funding yourself out of the profits, the free cash flow of your company. Well, that's offer power and execution power at work, right? Now it's leveraging the other powers, but you actually have to realize that potential in an actual performance. So that's where you have to convert competitive advantage into performance. And then some portion of that return, you need to now reinvest and create future power. And this is kind of the rinse and repeat of management cycles. So that's sort of like the philosophical platform for management. And then the last slide I'd like to say is, well, then what do we actually do how can we actually align our company to do this? And so first of all, I think the first thing you do is during your strategic planning process, you prioritize your portfolio. And then once you do this, you need to publicize this within your company so that everyone in your company understands these priorities. But I would put them in this order. First of all, do we have a tornado opportunity in view? Is there a category that is about to enter the tornado or is inside a tornado? If there is one, we have to make this number one. Tornadoes don't happen very often. When they happen, there's a 3 to 4 to maybe the most 5-year period where you can grab market share. You can create the next 10 to 20 years worth of future in that category or not. And so it's really, really important to strike when the iron is hot. So if you have an opportunity to participate in a category and there's a meaningful chance for you to get share, it should be the number one priority of your management team across all your businesses. Everybody on the team should understand this category in this year is the number one priority for every company, every employee in our company. Now, having said that, tornadoes don't happen that often. And so the second priority is, okay, well, I'm not in the tornado, but I got to run my core businesses. By the way, these are the engines that fund our company, that create returns. This is where we are today, giving service to our customers, being in service to the world. It's what's driving the employment engine for our employees, local communities, all those stakeholders that I mentioned at the beginning of this talk. They're all essentially impacted by the performance of your current lines of business. So let's just go after those. Because we live in an age of innovation, when disruptive innovations promise future tornadoes, that we live in an age of digital transformation, we need to be able to anticipate that. So we need to investigate those. We need to get involved with those and test them out and figure out, is this for us or is this not? We can't just sit on the sidelines and wait for them to appear on our door. So that would be number 3 priority. And then the fourth thing is, particularly if we're in categories which are beginning to lose their altitude, but still have a long runway, they're just no longer growing. They might even be shrinking, but we might have quite a large investment in the category, and our customers have a large investment with us and our partners as well. So optimization then becomes a really important focus for those categories, just essentially, making the category work better and better and better. And that would be number 4. But I would put them in that order. Tornado opportunities first, good, healthy, core business is number 2, potential future world beaters number 3, and then maybe some of our aging or problem child businesses number 4. And then, and this is what really I think does make it actionable, and this is where the Zone to Win book comes into play, is I think that each of those 4 priorities lends itself to being prosecuted in a different zone in the zone management framework. So the transformation zone is the zone that is dedicated to catching the next wave. And that's where you can really change your category power and company power. Frankly, it's the only way you can change your category and company power is to be able to participate in a genuinely new source of growth and earnings. And so when that opportunity comes, it's really important to catch it. And if you really are interested in managing for shareholder value, that's the thing that will dramatically change it. That when Microsoft got into cloud computing, you saw what happened to their market cap. It was already great, but you saw what happened even more. And when Netflix went from DVD to streaming, and then from streaming to media, you're watching their market cap go up and up and up, that kind of thing. When Amazon went from books to retail, and then from retail to cloud services, again, just huge changes in market cap because they changed their category power and had very high company power in the new category. Apple with music, Apple with smartphones, very high, amazing categories, and they were the grower. The performance zones really teed up to making the core business work. And this is where I think market power and offer power come in. Now, all performance zones understand offer power. They understand new product introductions. They understand competing. Not all performance management teams understand market power. Because they tend to get a little too distracted by the spreadsheet and not aware enough of the PowerPoint. But again, if you can concentrate your business into fewer sectors and give more value, you'll get better word of mouth, better status within that sector, therefore better ecosystem cooperation within that sector, lower costs of sales, higher value to the customer. There's all kinds of reasons to pursue market power. But I would say that market power is the art that some management teams have and some management teams lack. And it's really, really important to making the performance zone work. The incubation zone is designed for that next generation capability for possible futures that are they haven't even crossed the chasm yet. They're typically in what we call the early market. But you want to be able to keep in touch with them, and you may want to try to be the first mover in some new category and exploring it that way. Or you may be playing what we call defense and saying, look, I just want to make sure that if this category disrupts my industry, I'm not going to be blindsided by it. We'll know how to incorporate it into our plans and into our portfolio. And then finally, the productivity zone is where you both support your current performance zone. I mean, the main function of the productivity zone is to support the performance zone, but also for those aging company categories, or maybe even going to end of life, there's an optimization exercise that should be let out of the productivity zone, because just better focus. So for those kinds of ideas, see Zone to Win for details, because that's where they come. All these ideas are sort of built out in that book called Zone to Win, Organizing to Compete in an Age of Disruption. So just to recap then, the purpose of this talk was to try to give you a framework for understanding market cap, so it wouldn't be mystery, it could be more mastery. That's why we deconstructed the competitive advantage into gap and cap, because of this notion of short-term effects versus longer-term effects. And I wanted to show you some of the ways in which markets do respond to current events, because sometimes it is puzzling, particularly, when you beat earnings, you get a little bit of increase, and when you miss earnings, you get whacked. I mean, that's so disproportionate, the upside versus the downside. I want to make sure you understood what that's about. I particularly want you to understand the importance of a tornado category and how that really does have to reset the agenda of the entire management team, indeed of the entire company, and then gave you some key takeaways and actionable items for that. So that's what I wanted to share with you. Hope it's useful. And as always, if you have a comment or a question or a criticism, please do contribute it to the blog. Thanks a lot. Take care.